Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Redwire.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community, starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So, jumping right in today, we are looking at a stock that frankly sounds like something straight out of a movie.
Oh, it really does. I mean, imagine a company that builds combat-proven drones for the military down here on Earth.
Which is already a huge, highly competitive industry.
Right. But then they turn around and use that capital to manufacture advanced pharmaceuticals in zero gravity.
Wait, like actually up in space?
Exactly, up on the International Space Station. It sounds completely like the plot of a science fiction novel, but it is an actual reality. And it's the exact engine driving a massive 94.5% year-to-date run for the stock we are looking at today.
Yeah, and that is just an eye-watering gain. There is absolutely no denying that. Whenever a stock nearly doubles in less than 6 months, you're basically forced to pay attention to it.
You have to. You can't ignore that kind of momentum.
Yeah, but, when the chart goes parabolic like that, we have to put all the hype aside for a minute and ask the really difficult questions. I mean, for everyone listening, you have to wonder, is this just retail euphoria chasing a really cool futuristic story? Or is there a legitimate, unshakable foundation being built here for the future of the aerospace and defense sectors?
That is the exact question we need to answer today.
All right, let's move into the wealth building context.
So, to understand if that 94.5% run is actually sustainable, you really have to look at the structural role this company plays in the broader market.
Because if you were building wealth over a multi-year timeline, you don't want to just chase a flash in the pan.
Precisely. You want a company that creates indispensable infrastructure. Right now, the commercial space economy and global defense budgets are experiencing these, well, generational tailwinds.
Massive amounts of capital flowing in.
Exactly. And this company isn't out there trying to be the next flashy consumer space brand. They are quietly building the underlying hardware that makes those entire sectors function.
It's the classic pickaxes during the gold rush analogy, right? Don't mine for the gold, sell the shovels to the people doing it. But let's make that concrete for the listener. What does that infrastructure actually look like day to day?
It really comes down to something we call switching costs,
Yeah.
which creates this massive competitive moat for them. So take their space division, for example.
Okay.
They currently operate 9 active payload facilities on the International Space Station. And one of those is a highly proprietary platform called the Peel Box.
The Peel Box, what does that do?
It is specifically used to manufacture pharmaceuticals in microgravity.
Okay, I have to ask, why does a pharmaceutical company need to make drugs in microgravity? That sounds incredibly expensive.
It is, but the payoff is huge. Because down here on Earth, gravity causes things like sedimentation and convection.
Which messes with the chemistry.
Right. It creates these microscopic imperfections when you are trying to grow protein crystals for certain drugs. But in zero gravity, those crystals grew perfectly uniform.
Oh.
Yeah, that level of purity is incredibly valuable to pharmaceutical companies. Now think about their business model. Once a commercial pharma giant spends millions of dollars integrating their highly sensitive research into this specific payload system.
Getting it certified by all the regulators, I imagine?
Exactly. Getting it certified and then actually physically launching it into orbit. They're completely locked in.
Yeah, they can't just easily swap to a cheaper competitor next year to save a few bucks.
No, not at all. The switching costs are astronomically high. Add to that, they recently received major validation from the U.S. Space Force.
Which is huge.
Very huge. They were selected as an elite vendor for the $1.8 billion Andromeda IDIQ contract.
Okay, let's pause right there because I have to push back a little bit on the reality of government spending here.
Fair enough.
An IDIQ contract stands for indefinite delivery, indefinite quantity. To use an analogy for everyone listening, it's essentially like being handed an exclusive VIP pass to an all-you-can-eat buffet.
That's a good way to put it.
Right. So, yes, you made it into the room, and that definitely proves you are a top-tier player, but you still have to walk up to the line, grab a plate, and actually secure the food, meaning you still have to win the individual task orders to actually get paid.
You do. It's not a guaranteed $1.8 billion check tomorrow.
Exactly. So the real question for long-term investors is, are these high switching costs and elite vendor statuses actually translating into long-term wealth building? Or is this just locking the company into a slow-moving, heavily bureaucratic machine?
Now let's look at the fundamentals.
Well, let's do it.
Because to figure out if they are actually getting food at that buffet, we have to look straight at the raw financial data. And the truth is, the business model is unequivocally generating top-line growth.
The numbers don't lie.
They don't. In the first quarter of 2026, they reported revenue of $97 million.
Just in Q1.
Just in Q1. That is a 57.9% year-over-year increase. And addressing that concern you just had about the slow-moving government bureaucracy, they actually have incredible revenue visibility right now.
Because of the backlog.
Exactly. They are sitting on a record contracted backlog of $498.1 million.
See, that backlog is a massive cushion. It means even if the economy halted and new orders just completely dried up tomorrow, they still have nearly $500 million of work already on the books.
Right. It significantly de-risks the immediate future.
Yeah.
And because they have that clear pipeline, management actually just heavily bumped up their full year 2026 revenue guidance.
What are they projecting now?
A range of $450 to $500 million. And for perspective, they only recorded $335 million in 2025.
Okay, so the top-line growth is certainly aggressive. But you know me, I want to lean hard into the risk side of the ledger here, because while the top line looks great, the bottom line paints a radically different, frankly concerning picture.
You're talking about the profitability.
I am. They're currently deeply, deeply unprofitable. We are talking about a profit margin sitting near negative 80%. It's brutal. And a staggering net loss of $300 million over the trailing 12 months. A huge chunk of that cash bleed, from what I see, is tied to their massive $925 million acquisition of Edge Autonomy back in 2025.
Yes, that was a very expensive acquisition.
Right. And I know that deal is what gave them the Penguin Mk3 unmanned aerial system.
The drones we were talking about.
Yeah, a drone that is actually combat-proven right now. But that deal essentially doubled the company's debt overnight. If your margins are negative 80%, scaling up the business just means you are losing money faster. How does that acquisition actually fix the cash burn?
Well, that is the friction of scaling a dual-threat powerhouse. Yes, the free cash flow is currently deeply negative. You can't ignore that. But you have to look at the leading indicators.
Okay, what are they showing?
In the first quarter, they posted a robust 1.92 book-to-bill ratio.
Meaning they are booking almost twice what they are billing.
Think of it like a bakery. For every one cake you sell and bill a customer for today, you receive guaranteed orders for nearly 2 more tomorrow. Demand is aggressively outpacing what they can currently fulfill.
Wow. Okay.
That ratio is the ultimate leading indicator for future profitability, especially as they begin to realize the operational synergies and the cost-saving combinations from integrating that Edge Autonomy acquisition.
But that brings up a harsh reality for the everyday investor. How does a company with a $2.8 billion market cap survive a $300 million net loss, plus all that new acquisition debt, without constantly diluting the shareholders' wealth?
That's the tightrope they're walking.
Right. I mean, they just executed a $260 million equity raise. Every single time they issue new shares to keep the lights on, the slice of the pie for you, the investor, gets smaller and smaller. They desperately need a major event to re-rate this business before that debt load becomes unmanageable.
That brings us to the catalyst timeline.
Exactly. What is on the horizon?
Well, if you are looking for an event to bail out the balance sheet and accelerate that revenue realization, the immediate future is stacked. The single biggest macro event looming over this entire sector is the SpaceX IPO.
Oh, man. That is going to be massive.
It really is. It's scheduled for June 12, 2026. And SpaceX is expected to hit the public market at a valuation of around $1.7 trillion.
Trillion with the T. That is going to be an absolute earthquake in the markets.
It is. When a titan like that goes public, it forces institutional capital to completely recalibrate how they value space assets. It's going to act as the ultimate sector re-rating catalyst. Institutional money is going to just flood into the space sector, and the pure-play space infrastructure companies, the ones building the actual hardware, are going to be the prime beneficiaries of that capital reallocation.
It's a classic rising tide lifts all ships scenario, right? It's a recalibration of scale. Because if the market suddenly decides the industry leader is worth 1.7 trillion, then a competitor or an infrastructure provider sitting at a $2.8 billion market cap suddenly looks like a rounding error. It completely shifts the perceived value.
Precisely. And the catalysts aren't just limited to the space division either. On the defense side, the geopolitical landscape is unfortunately rapidly deteriorating.
Very true.
The recent U.S. and Israel strikes on Iran are forcing these aggressive, rapid capital rotations into the defense sector. That directly benefits their unmanned aerial systems division, those edge autonomy Penguin drones we talked about earlier.
So they are catching tailwinds on both sides of the business.
Exactly. We will get our first real look at how these dual catalysts are actually impacting the bottom line during their Q2 2026 earnings in early August. Wall Street is going to be hyper-focused on whether those negative margins are finally compressing.
I completely understand the momentum behind a sector re-rating like the SpaceX IPO, but I have to throw some cold water on this again. Is this company a sturdy enough boat to actually ride that SpaceX wave, or are retail investors just blindly buying rumors?
What rumors are you seeing?
Well, let's look at what's happening on the message boards right now. There are these highly speculative, totally unconfirmed rumors floating around that SpaceX and Alphabet are engaging in talks to build orbital data centers.
Yes, the data center rumors.
Right. And because this company is a known supplier of space avionics, people are automatically assuming they will get that contract. I have to warn anyone listening to this. Trading on unannounced, unconfirmed contracts is incredibly risky. It makes for a fantastic story, sure, but until the ink is physically dry on a contract, you are risking your capital on a ghost.
Now let's pivot to the chart.
Yeah, let's see how this is actually trading.
Setting the abstract rumors aside, we need to look at how the market is physically moving this stock day to day. Currently, it is sitting at $17.56. That puts it about 13.6% below its 52-week high of $20.57, which it just tapped earlier in June.
Okay, so it pulled back a bit.
Yeah, so it's consolidating right near the upper boundary of its historical trading range.
Consolidating maybe, but the volatility on this thing is absolutely brutal.
It is extreme, I'll give you that. We are tracking 98 separate moves of greater than 5% over the last year alone.
That is almost 2 massive swings a week.
It's a lot. But what is truly fascinating is the psychological behavior driving those violent swings. The stock has a habit of aggressively gapping down on macroeconomic fears.
Like what?
For example, if a hot CPI print comes out, meaning inflation is running higher than expected, which terrifies investors about interest rates, the broader market just dumps the stock instantly. But almost immediately, it gets bought up aggressively by investors reacting to microcatalysts.
It's like a new defense contract being announced?
Exactly. It shows there is a massive pool of buyers sitting on the sidelines, just waiting for any excuse of broader market weakness to build their positions at a discount.
You know, as someone who constantly analyzes risk, that specific behavior tells a huge story. A 45% run-up in just 4 weeks is incredibly steep. High-frequency trading algorithms are almost certainly flagging this asset as technically overbought right now.
Oh, absolutely.
And when a stock's price action is driven this heavily by momentum rather than fundamental earnings, the psychology of support levels becomes your entire world. If the stock breaks below a key psychological price floor, the exact same algorithms that blindly bought the momentum up are going to ruthlessly sell the breakdown to protect their gains.
That's just how the machines work.
Exactly. So my question is, how does a conservative investor manage this level of extreme volatility? How do you survive a 5% daily swing without getting completely shaken out of your position? You have to have a stomach of absolute iron to hold through those morning gap downs without panic selling. So what does market sentiment look like?
Well, to survive that kind of volatility, it really helps to understand who is actually holding the stock alongside you and what the professionals are saying. Right now, the overarching mood is overwhelmingly bullish.
Okay.
The consensus on Wall Street is a strong buy, carrying a remarkably high confidence score of 4.50 out of 5.
But who is actually driving that daily volume? I mean, is it institutions quietly building positions, or is it just retail traders chasing a green chart?
It is a really powerful combination of both. On the retail side, we saw a massive influx recently, with net buying hitting a record $25 million in a single week.
Wow.
But we are also seeing institutional whale alerts triggering consistently in recent sessions. A massive driver of this volume is the broader sector momentum. Over the past month alone, $1.3 billion has flowed directly into space-focused ETFs.
That is a staggering amount of capital.
It is. And this company is a top holding in funds like the Team of Space Innovators ETF.
We really need to highlight why that matters for the listeners. An ETF flow acts as a massive passive bid underneath the stock. When a retail investor buys a share of a space ETF, that fund manager is structurally obligated to go out and buy shares of the underlying holdings, regardless of whether the stock is technically overbought.
Right. They don't have a choice.
Exactly. It creates relentless price-agnostic buying pressure.
And that passive bid is being fed by a continuous drumbeat of tangible news flow. They were just selected as the prime contractor for the DARPA Otter VLEO spacecraft program.
VLEO.
Very low Earth orbit. It is a highly complex environment where atmospheric drag requires constant advanced propulsion, which creates a huge engineering moat for them. On top of that, they just landed a multi-year, high eight-figure NATO contract for those Penguin drones, along with a $15 million U.S. Army Stalker UAS order. The narrative momentum is incredibly potent right now.
The narrative is potent, yes, but I want to point out a glaring disconnect between the story and the math. You mentioned Wall Street has a strong buy consensus, right?
Yes, 4.5 out of 5.
But if you dig into the actual analyst notes from firms like Canaccord and Jefferies, they both recently maintained their buy ratings, but their actual price targets are only $14 and $13 respectively. The stock is currently trading at $17.56. Why is the retail crowd bidding this stock up nearly $5 past the absolute highest price caps set by Wall Street professionals? It strongly suggests that investors might be getting completely ahead of themselves, just blinded by the hype of the impending SpaceX IPO.
Now let's talk about the risks.
Please.
Because that skepticism you have is exactly why we have to lay out the harsh realities that could completely derail this bullish thesis. The most immediate existential threat here is execution risk.
On the edge autonomy deal.
Exactly. That $925 million integration is the linchpin for the entire company's survival. Integrating two entirely different corporate cultures, merging massive supply chains, and actually realizing those promised cost synergies. It's incredibly difficult.
It rarely goes smoothly.
Right. And if management stumbles and production slows down even a little bit, those negative 80% margins are going to compress even further.
And the macroeconomic environment right now is absolutely punishing for a balance sheet carrying that much acquisition debt.
Very punishing. They're facing soaring input costs across the board. Brent crude oil is sitting around $107 a barrel, and the ISM Prices Index, which tracks the cost of raw materials for manufacturers, is blazing hot at 84.6%.
Ouch.
When you combine those skyrocketing material costs with high treasury yields, which are currently sitting at 4.43%, the cost of capital for their debt-financed operations becomes a massive, crushing anchor.
I really want to drive this point home for you listening. High treasury yields and expensive oil are the natural apex predators of unprofitable, debt-heavy growth stocks. It does not matter how futuristic or incredible your space infrastructure is.
The math has to work.
Exactly. If it costs you $2 in raw materials and labor to build something that you are contractually obligated to sell for $1, and the interest payments on your massive debt pile are skyrocketing simultaneously, you are in deep trouble. That record $498 million backlog is fantastic on paper, but those long-term contracts must execute flawlessly. If raw material prices spike and they are locked into fixed-price government contracts, their profit margins will instantly evaporate. They have to navigate this macroeconomic minefield perfectly without diluting their shareholders into oblivion. So with everything on the table, what's the final verdict?
Synthesizing the entire fundamental, technical, and catalyst landscape we just went through, the research provides a highly bullish score of 8 out of 10.
Wow, an 8 out of 10.
Yes, the overarching investment view here is a specialized dual horizon strategy. So the immediate play is a short-term swing trade designed to capture the massive sector momentum leading up to the June 2026 SpaceX IPO.
Ride the hype wave.
Exactly. But once that specific macro event passes, the strategy shifts into a multi-year hold. That long-term view is firmly anchored by their massive contracted backlog, the high switching cost of their ISS payload systems, and the undeniable structural tailwinds in global defense spending. The foundation for immense wealth building is clearly there, provided they can flawlessly execute the edge autonomy integration.
If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.